Welcome to AM Best Audio.
It's imperative that insurers stay resilient in today's increasingly complex marketplace, where volatility, shifting credit conditions, and emerging risks can quickly reshape the investment landscape. Elizabeth Henderson of AAM brings a steady, research-driven approach to helping insurers navigate these challenges. With a focus on disciplined credit selection, active risk management, and capital efficiency, she offers insights into how insurance portfolios can remain both resilient and opportunistic in the face of evolving market dynamics. I'm John Weber for Best Review Magazine. Elizabeth Henderson joins us now to tell us more. Elizabeth, so glad you could join us today.
Thank you. It's great to be here.
So, Elizabeth, you recently published an outlook highlighting that corporate fundamentals remain supportive of credit quality despite rising volatility. What's the key takeaway for insurance investors right now?
Yeah, the main takeaway is that fundamentals and headlines are telling two different stories. Volatility has increased meaningfully this year, driven largely by geopolitical developments and energy markets, but most corporate balance sheets remain healthy. Defaults are low, leverage is generally stable, and companies are still funding capital spending internally rather than relying heavily on debt markets. For insurance portfolios, that creates an environment where being selective matters. There's still attractive opportunities to enhance yield without compromising credit quality, provided investors stay disciplined and forward-looking.
What do supportive fundamentals actually look like from your analyst perspective?
Yes, so from an analyst standpoint, supportive fundamentals show up in a few consistent ways. We're seeing stable or expanding margins, manageable debt leverage, and capital allocation that remains internally funded rather than debt-driven. Top-line growth expectations are still positive for most sectors, even outside the largest technology companies. That doesn't mean risks aren't present, but it does mean that many issuers entered this period from a position of strength. So the job of our analyst team is to differentiate between companies that can absorb shocks and those that are far more sensitive to changes in rates, energy costs, or end market demand.
Elizabeth, how does characterizing the market as mid to late cycle shape your credit strategy for insurance companies?
Yes, so in a mid to late cycle environment, which is what we believe we're in today, the focus naturally shifts from chasing spread to protecting against downside risk. We spend much more time stress testing the issuers in our portfolios, and that includes examining spreads being earned today versus various points in history for sectors that are more economically sensitive in particular. For insurance portfolios, that analysis is especially important because credit deterioration doesn't just affect returns, it can have capital implications under NAIC risk-based capital frameworks. So our goal isn't to predict a downturn necessarily, but to position portfolios so they remain resilient both economically and from a capital perspective as conditions evolve. The first quarter this year was a good stress case for our portfolios.
So how was AAM positioned heading into the recent volatility, and why?
So heading into the volatile first quarter, our portfolios were positioned with a focus on managing inflation sensitivity and avoiding areas where valuation offered little margin for error. We entered the period underweight longer duration financial corporate bonds as one example, which tend to be more vulnerable when rate volatility rises and inflation risk resurfaces. At the same time, we emphasized structured sectors such as asset-backed securities, where valuations were more attractive and cash flows are less exposed to inflation-driven repricing. We also maintained an overweight to taxable municipal bonds, especially in the longer part of the curve, because we saw strong credit quality and lower economic and inflation-related sensitivity relative to other spread sectors like corporate bonds. Within mortgages, our preference for non-agency mortgages also was a benefit, as they have less convexity and repriced less dramatically than agency pass-throughs. So overall, our portfolios were positioned to emphasize income, diversification, and structural resilience as volatility increased.
Energy is highlighted as one of the key risk areas in your outlook. So, Elizabeth, what makes it different from prior energy shocks?
Yeah, what's different this time is the source and the speed of the shock. The disruption tied to the Strait of Hormuz has driven sharp increases across oil, refined products, and natural gas in a very short period. That creates uneven impacts across sectors. Some issuers absorb it easily, while others see margin pressure almost immediately. Rather than treating energy as a top-down macro call, we're focused on how energy costs flow through the individual income statements and balance sheets. The duration of elevated prices is critical, of course, and that uncertainty makes the bottom-up analysis particularly valuable.
How does your team actively manage energy exposure in insurance portfolios?
We approach energy exposure with a combination of fundamental analysis and then trading discipline. On the research side, our energy analyst, Pat McGeever, has close to 30 years of experience. Pat assesses company fundamentals and liquidity under stress scenarios. And then on the trading side, our firm's size and relationships with Wall Street allow us to then buy and sell bonds freely in the market without affecting their price. For insurance portfolios, that active approach helps avoid situations where a seemingly stable issuer becomes a problem credit due to unforeseen commodity or geopolitical developments.
You also flagged private credit as a growing area of concern. Why should traditional fixed income investors care?
The most direct connection runs through pricing and valuation. Private credit has grown by absorbing institutional and retail capital that might otherwise have flowed into other markets, and in doing so has intermediated credit risk that in an earlier cycle would have been continuously priced in the broadly syndicated loan market or held on bank balance sheets. As that risk begins to surface through non-rising non-accruals, redemption gates, or markdowns, two things follow. Capital rotates back into other markets, putting pressure on spreads and lending terms, and assets underwritten in the private market are forced into public price discovery, or if possible, back onto bank balance sheets under more stringent underwriting standards. In any case, that repricing is unlikely to be orderly. Of course, private credit at this scale doesn't de-risk quietly.
Do you expect downgrades to high yield for private credit related issuers that are currently investment grade?
Yes, in short. Rating agencies have placed the sector on negative outlook, more so because of the asset quality issues. Recent downgrades to high yield have related more to that. However, we are seeing other negative trends, such as increasing leverage and funding starting to tighten, which likely means more reliance on secured funding and gradual pressure on unsecured creditors. Our experienced finance analyst, Leah Savageau, assigns her own credit ratings to issuers, and she currently views more than a half a dozen issuers in private credit to be more consistent with high yield ratings than investment grade ratings. So going back to fundamentals, she believes fundamental pressures are real, and upcoming earnings, especially any softness in software portfolios, will be the next test for the sector.
Elizabeth, how does analyst-trader collaboration translate into better outcomes for insurance portfolios?
The integration between research and trading allows us to pair strong credit conviction with efficient execution. Analysts identify where fundamentals are improving or where risks are overstated, and traders help capture those opportunities in a cost-effective way. For insurance portfolios, this coordination helps us enhance yield while staying aligned with NAIC guidelines and overall capital efficiency. In volatile markets, that balance becomes increasingly important as pricing can move faster than fundamentals, of course.
Elizabeth, can you explain how this approach helps enhance yield without increasing risk?
Yield enhancement doesn't have to mean taking lower quality risk. Often it comes from structure, sector selection, or timing. For example, two bonds may carry the same credit rating, but differences in maturity, seniority, or issuer-specific technicals can create meaningful yield gaps. Our analysts and traders work together to find those pockets of incremental compensation while staying aligned with insurance-appropriate risk parameters. So over time, those small decisions can compound into better portfolio outcomes without sacrificing credit discipline.
How is AAM thinking about opportunism in volatile markets, and how do you frame the outlook for rates for insurance investors?
If volatility certainly can feel uncomfortable, but for long-term insurance investors, it often creates opportunity, particularly through reinvestment yields. Rather than focusing on predicting the direction of rates, we frame the environment around what it means for income over time. Higher or more volatile rates typically improve the forward reinvestment opportunity set, especially in high-quality fixed income sectors. At AAM, opportunism means being ready to deploy capital when dislocations emerge, whether through new issue concessions, spread widening in fundamentally sound issuers, or structural opportunities in sectors like structured credit or taxable municipals. For insurance portfolios with ongoing cash flows, today's environment supports higher portfolio yields over time, provided those opportunities are accessed selectively and with discipline. That reinvestment dynamic is a key pillar of how we think about long-term portfolio outcomes in volatile rate environments.
Elizabeth, how does AAM think about modeling portfolios for scenarios like rising interest rates, and what does that analysis tell you about sector behavior?
We spend a lot of time modeling portfolios across different rate and volatility scenarios to understand how income, duration, downside risk may evolve, not to predict the outcomes, but to improve resilience. In rising rate environments, our analysts are focused on how different sectors behave when yields reset higher, volatility increases, and option costs reprice. That lens helps us evaluate both near-term price sensitivity and longer-term reinvestment dynamics for insurance portfolios. For example, in structured credit, sectors like CLOs and high-coupon mortgages tend to behave differently than traditional duration-heavy assets. CLOs benefit from floating rate coupons that reset higher as rates rise, supporting income even when prices are volatile. Similarly, higher coupon mortgages often exhibit less extension risk and can perform more defensively once prepayment behavior stabilizes. By incorporating these dynamics into our scenario analysis, we're better able to build portfolios that are positioned not just for a single outcome, but for a range of interest rate paths while remaining focused on income stability and capital preservation for insurance investors.
So, Elizabeth, what should insurance investors stay focused on through the rest of 2026?
The environment calls for balance, recognizing that corporate fundamentals remain supportive, while also acknowledging that risks are becoming more concentrated. Energy, private credit, and refinancing dynamics warrant close attention. For insurers, success in this environment isn't just about returns, but about maintaining capital flexibility and avoiding the avoidable downgrades. We believe long-term outcomes are driven by disciplined credit work, active risk management, and a clear understanding of how investment decisions intersect with regulatory capital over time.
Thank you, Elizabeth.
Thank you. It's been great.
That was Elizabeth Henderson with AAM, and I'm John Weber for Best Review Magazine.
Looking to get the full attention of the insurance industry? We have the platforms that will do just that. Whether it be AM Best TV, AM Best Audio, Best Review Magazine, or Best Day. Find out more by calling AM Best Advertising Sales at 908-439-2200, extension 5399, and have a great day.